Good morning, everyone. Hey, this is Bernard with Insurance Advisors Direct. And I know we've been silent for a minute on our webinars, but of course we had to wait, after AEP, let some of you guys do your thing during AEP. So we are back. And to kick this off, we're going to be talking about your route to retirement. And we have a specialist, Chris Schleifer. He's going to be talking about tax diversification strategies within retirement. So not to belabor this, I'm going to, Chris, you can take it away, my friend.
Did you want to wait a minute or two to see if anybody else gets on, or do we want to just get going in the sake of everybody's time?
Yep, here, let's get it going, my friend.
Okay. Well, good morning, everybody, and thank you for being here with us. Very excited to go through this presentation. It's something that me and Bernard have talked about. He's seen, and he thought it was very valuable to make available to you all. So when I was putting this together, this presentation is a presentation that's put together for the public, right? It's for you, the advisor, to be able to use with your prospects and your clients. So today, when I go through and do this presentation, I'm kind of changing it a little bit in a sense that I'm gearing it towards you all that are here listening to it, so you could see what this concept is, so you could see what the problems that your clients are going to have reaching retirement, okay? And with that, you're able to call and get a hold of Bernard and the other good folks over at Insurance Advisors Direct, and they could help you to understand how to design a plan that can incorporate these products to help them, okay? So without further ado, here we go. The route to retirement, right? So when you're sitting with your clients and you're talking with them, and people start talking about retirement, today my job is not to totally go in depth with that, right? My job is just to let them understand that they need to know right off the bat, hey, you got to know where you're going or where you want to go. We can't just jump into this pool and hop right in the deep end, right? You can't just say, hey, I want to retire. You need to understand when you want to retire, what you want that retirement to look like, where you want to be with it, okay? Does your client say to you, I want to retire and stay right here in Michigan? Plan on seeing the grandkids, watching them grow up, seeing them play sports, do things like that. You might have other people that say they want to move to a tropical island, they want to move to Florida, whatever it might be. You can see the slides here, right? Play golf, garden. Maybe some of your clients just want to get out with their significant other, with their spouse, and just, walk and see things with their leisure time. But the point is, when you are talking to your clients, they need to understand that there's problems that they're going to run into along the way getting to retirement. Okay? And one of the first problems is too many people today get their first job and they simply say, I got a 401k, that's good enough. What they don't do is try to sit down and carefully map out the course they're going to take to retirement. Now, I don't want to assume anything, but I'm sure most of you on this call today understand that the sooner you start saving, the sooner you start planning, the easier it's going to be to reach that goal. You as the advisor need to make sure that your client understands you're going to help step them through this, and that their plan does not need to be full and all-encompassing day one. But there does need to be a map put together so you as the advisor can do right by your client, stay compliant with your client, and make sure that they're continually, year by year, stepping towards the goal they have to reach retirement, right? So when we talk to them about that, what we want them to understand is that they're going to run into two types of obstacles. They're going to run into traditional obstacles, right? These are the obstacles that, your parents, your grandparents might have had growing up or getting into retire through their working years, right? These are still there today, but we also have new obstacles as well. Okay? So when we think about these, what are they? When we look at those traditional obstacles, they're people living longer, right? This is an adage that came around, in the 40s and 50s, is that, medicine got better, science got better, living conditions got better, people started living longer. Now, on one side, living longer is great, but it does bring problems. And the problems are you need to have more money to last longer so that you could, do things. So when we look at people living longer, and I know I skipped the other two on there, market risk and inflation, but I just like to go through it here. But when we look at people living longer, right? Like I said, it's a great thing. It's something that is there that's helped us to live longer, but it's also we got to make sure we have more money. Look right here, a male age 65, very easily normal life expectancy is going to live to 89, right? I mean, what is that? 25 more years? I mean, they got a whole other life to live after they retire. Women a year longer, but look at couples. Couples, man. Look at these numbers. To age 94, that's like almost 30 years. Think about that. To well over 30 years. So, to make sure that you have money to do this, what happens is many times people take market risk. Now, I'm not here to tell you that the market's bad because I don't believe it's bad. What I do believe is at certain times in life, the market can become a detriment, whether it is the risk of losing money, whether it's the anxiety that somebody has each night when they lay their head down on the pillow to go to sleep. What does market risk bring to us? Well, what we know is this, is it's going to happen. Since the 70s all the way up and through the pandemic we just had, you can see that basically every decade we got some sort of recession that happens. Now, that in of itself, again, is not a problem unless you retire in 1973, or unless you retire in 1972, or unless you plan to retire in 1974, right? A 48% decline really is going to hinder your ability to retire. It's going to hinder the ability for your money to last throughout your retirement. If that happens, and what I'm talking about is sequence of returns, okay? The downside itself is not horrible, but if it happens strategically at certain times, and I often say it's the year before, year of, or the year after, this can truly hinder your client's ability to have a fruitful retirement or to retirement. So what you need to understand and know is sequence of returns. And here's what I want to say to you folks. If you don't understand that, if you don't get that, this is where and what the good folks at Insurance Advisors Direct are able to help you with. It's what Bernard can do, okay? This is another opening for each and every one of you to talk to your clients, all right? I know you help them with Medicare, and you guys are all professionals and do wonderful. You might write some life insurance and do some other stuff, but when you put into play, when you start talking to your clients about taxes, tax diversification, and market risk, talk to Bernard because he's got the tools to help you get them products that can help them get strong upside returns, but limit their downside, meaning they'll never lose a dollar that they put in. Okay? Look at this right here. When we think about this, when we look at a scenario of somebody that, they retire, and the first year of retirement, they get a 27% return. The second year, they get a 9. The third year, they get a 7. And the fourth year, they get negative 15. Person number 2 retires, gets a negative 15 the first year, a 7, a 9, a 27. All I did was flip the numbers here, folks. And this is an average washed out 8% return over that 4-year period of time. They both have the same 4-year return. But because of where those returns happened, okay, the person that was negative in the first year, their money is going to last 13 years less. Their money is only going to last for 24 years versus the other person that's going to last for 37. Folks, you go out and you help your clients, right? You help them with their Medicare. And I know when you're doing this, we're talking about people that are turning 65, that just past 65 and in that range, right? But you want to know what's unique to those people. One, they still need your help with things like this. Two, they have kids and they have grandkids that you could talk to about how they need this sort of planning. All right? Make sure you understand this. Inflation. Inflation was another big one, and it's something that's still there. Shoot, we're all seeing it today, right? Inflation could happen due to poor economic policy. It could happen due to unforeseen things that happen like a pandemic, right? The cost of beef and things like that is really going up. I mean, look at inflation traditionally. I always say this, man. I get real jealous when I think about this Mustang GT convertible, $3,000 in '68. Ooh, how much fun would have that been? Today, you're talking 45,000 plus. Okay, but when you really look at here, look how these numbers jump from 68 to 85. Moves just a little bit, right? But when you start getting in this range, you're talking about a 7-year period of time, and look what it jumped. Okay, the price of goods are going up. It's always going to happen. So when you put all that together, right? Living longer, inflation, people feel they have to get better returns. They take market risk. Market risk could then be great for them or it could hurt them. What you're able to do is you're able to help people tackle two of these problems, right? You're able to take market risk off the table. You're able to take inflationary risk off the table because Bernard has some products he could help you with that give you the upside of the market without the downside. I'm sure many of you know what that is in indexing products. So when we look at the new obstacles, folks, and you got to make sure that your clients understand this. You have got to, right? Social Security uncertainty, we've all heard that. Diminishing pensions, they're gone. And I'm sure out there in Michigan, in the Detroit area, I mean, I don't mean to, I guess, no pun intended, but diminish the fact that maybe there was car building and factories and other places outside Detroit. But, diminishing pensions, right? Is everybody there still have their pensions? Right? I mean, these things are hard. And then here's the biggest one of all, taxes going up due to our national debt, right? Let's look at Social Security here and let's get a strong understanding of what they're talking about and why your clients need to talk to you now. 2035 is about, 12, 13 years away? They're talking about making a permanent increase of 3.65% on payroll tax. That means your clients, your prospects, the people you're going to talk to are going to have smaller paychecks in 2035, all being relative, taking out pay increases and stuff like that, right? They're going to pay more in payroll tax. They need to talk to you now. They need to start now while they're being taxed less. They got more money to give you. Here's the other reason. The other thing being kicked around out there is actually a permanent 23% reduction in Social Security benefits starting in 2035. Man, that hits a lot of us on this call today. 23%? I mean, think about that. You get $1 today that you think you're going to be able to spend. Tomorrow, it's only going to be 75 cents. Wow. What really we're probably going to be looking at is some sort of combination of both. But what the point is to you all here, when you talk to your client, is there's so many what ifs out there. They need you to show them these what ifs and help take that out of their planning. Show them how you could help them today save money so that they don't have a 23% reduction in their retirement money, right? Show them why they need to do something today, because right now they're not getting taxed this extra amount in payroll tax. I'm not even talking about the fact that other taxes are going to go up. Diminishing pensions. We'll just leave this one here, right? Even if pensions aren't diminishing, I'll tell you one thing that's happening. Simply go do a Google search and say, hey, what's going on in Michigan? Hey, Bernard, could everybody hear me still? Yeah? I just had something happen that popped up. I don't know what to do here. Okay. Something popped up on my screen that was saying keep your phone connected. I'm sorry, everybody. Pensions, all you got to do is do a simple Google search, right? What's that Google search going to tell you? It's going to tell you that a lot of companies, a lot of cities, a lot of states, the pensions aren't funded. I'm not here to tell you that they're not going to pay out, but I'm here to tell you, don't put all your eggs in one basket because you don't know what's going to happen. Don't let your clients do that. All right, so check this out. We contend for a nation to try to tax itself into prosperity is like a man standing in a bucket trying to lift himself up by the handle. It ain't going to happen, right? The problem is you can't just sit there and tax everybody to death. You tax them to death, they don't have money to spend. They don't have money to spend, the economy's going to halt. But here in America, we got a problem, right? And what is that problem? We're 28, almost $29 trillion in debt. Trillion. I don't know if anybody here truly understands. My slide says 23 trillion. Bernard's seen this before. I strategically left that there. We were $23 trillion in debt the day before the pandemic started. We added roughly $6 trillion through that pandemic. What's it been? 2 years? A year and a half? 6 trillion? Come on. Ladies and gentlemen, that is a lot of money. And I don't know if you fully understand how much that is, right? When you look at this, though, it's more than $70,000 of debt per living citizen in this country. Yet, we only collect on average $17,000 per year per person. No way to pay it down like that. They are going to raise taxes. And this, my friends, is the single biggest problem your clients are going to have with retirement. Now, the good news is you could help them. So let's talk about $1 trillion just so we all here can grasp how far in debt the United States of America is. If you take a dollar bill weighs about a gram, okay? If you have $1 trillion bills, you do all the math on it, bing, boom, bob, what do you get? 2.2 billion pounds, all right? Wow. 2.2 billion? That's how much $1 trillion bills weighs. Now, I don't even know if you could justify or quantify what that is because I couldn't. So I kept digging when I was putting this together. Here's the bottom line. 2.2 billion pounds, that's the weight of 630,000 mid-sized cars. That's a lot of weight. Here's what's even more so. If we assume these mid-sized cars cost $20,000, all right? If we assume they cost $20,000 with $1 trillion, you could buy all 630,000 of those cars 385 times. That's just $1 trillion. We're $29 trillion in debt. So how do you offset debt when you're the United States of America? You spend less or tax more. Here's my question to you. What do you think is more realistic? See, folks, here's what you need to do. You want to stay in business, you need to talk to people, right? People are always engaged and worried about what's going to happen in retirement. You need to let them know that you're able to help them become tax diversified. You need to ask people the very simple question. We're $29 trillion in debt. Did you know that? Most people are going to say, yeah, but here's the kicker. Do you think it's possible that taxes will go up? Almost everybody's going to say yes. And if they say yes, you got the silver bullet. You could help them become tax diversified because you got the ability to help them get above the line with the products that you could talk to them about. So when we look at some stuff that's been going on, now's the time. Don't take what I'm telling you and just put it in your back pocket and forget about it. We had a new tax law go in effect in 2018. It lowered tax rates for some people. It's going to sunset in 3 years. Let me tell you what I do a lot of, okay? I want you to understand this, comprehend this. Think about your own clients. Many of you have probably sat down with a client. You found out a client's getting ready to retire. You know, they need to move their 401k into an IRA. You do the simple thing, right? The simple, easy thing. You call somebody up and they go simple-minded on you and they say, yeah, take and move that to an IRA. Whether it's an annuity, whether it's a brokerage account, a mutual fund, an ETF, a stock, whatever it might be, or a CD in the bank, all you do is sit there and go simple on them and say, yep, let's move this to an IRA. Let's kick the can down the road to when you have to start paying taxes, and you got to take required minimum distributions to pay those taxes. Here's the deal. What I do, I take a third of their qualified money. I take a third of their 401k. I take a third of their IRA. They got $300,000. I take $100,000. I pay taxes on it now. And I move that over to a product that's going to grow, eliminate market risk, outpace inflation, and it's going to be tax-free in the future. I am helping them become tax diversified. I am doing something different, a wholehearted plan for somebody that other people are too scared to do. So when we look at the top marginal federal income tax rates, look at this. From 1938 to 1983, on average, they were over 70%. Today, we're at 37, right? Wow. Even in some of these years, we were over 80 and over 90%. You know, we've really flipped that around. We went to war. We started paying out billions of dollars month over month at the same time as lowering taxes. And what it's done is it's caused a problem to where our debt is so high, they're now saying they got to raise taxes on us, the middle class. So see, while we were lowering taxes, the government continued to spend. And this is why taxes are going to go up, because they really can't lower or eliminate spending, right? The fastest growing expense in the federal government is interest. Within 10 years, we could be paying more for interest than our national defense. This is from David Walker. Don't know if you know who he is. He was CPA, Comptroller General. He's the guy that controlled the checkbook for the United States of America for a while. Our national defense budget has always been very high, one of the top line items. And now with interest being more than that, how can they lower enough cost to not have to increase taxes? They can't. So it's your job to help your client. It's your job to help them understand the types of money that they have so they can reach their goal. It's your job to help them start now and to show them why they need to. When we look at money, what do we got, right? We got taxable money. We all understand what taxable money is, right? We got tax-deferred money, and we got tax-free money, which if you heard the phrase I said before, help your clients get above the line. We want to help them get as much money tax-free, right? So when we look at taxable money, we're talking about things like stocks, mutual funds, CDs, savings accounts, your current income. What's tax-deferred stuff? 401ks, 403bs, annuities, IRAs, right? Pensions. These things are all going to be fully taxed. and they're all starting in 2025 going to be taxed at a higher rate than they're taxed at right now. So you got a 3-year window to help people start doing stuff to get some money where it's going to be tax-free. So when we look at tax-free money, what do we have? Everybody's heard of the Roth IRA. You have 7702 plans, otherwise known as life insurance, and you have muni bonds, okay? Municipal bonds really are not very common among individual consumers, right? They got a very low rate of return and actually have a high risk. Roth vehicles are great, right? They give you the ability to pay income taxes today at a historically low rate. It accumulates tax deferred and it's tax free in the future. It's awesome. But there are problems. Some people make too much money. They can't contribute to a Roth. Or some people make a lot of money, but they're still able to contribute, but they can't contribute as much as they want to. This is where 7702 comes into play, right? This is where IULs, cash value life insurance, one of the best and most common vehicles out there to accumulate wealth, right? There's no contribution limits. There's no income limits. You don't have to wait till 59 and a half to get your money. The type of stuff that Bernard's going to talk to you about is going to give you the upside of the market without the downside. We're going to have self-completing features, living benefits, income that's tax-free in retirement, right? I don't know about you. I don't know about the state of Michigan, I should say, but some states you're protected from creditors with your money that's in there. Getting to the end here, folks, and then we can ask some questions. But the bottom line is this: annual reset is the best feature, in my opinion, in the financial markets today. That is a feature that allows you within your account, as you can see here, the black lines, the market index going up, the blue lines, your cash value going up. You can see year one, it goes up, and then there's a lock there because your money's locked in. You won't lose anything. Year two, the same thing. Year three, notice you don't lose any money, but the index went down, right? All you get is 0. Year four, the market recovers. But here's the trick. See, you start earning money. You start getting your return from that low point in the market, right? But those of you that were fully invested in the market with your 401k, your IRAs, your brokerage accounts, whatever it is, and again, I'm not saying they're bad. I'm just saying don't have all your eggs in one basket. And if you already have a 401k or a 403b that's invested in the market, why not take additional monies and put it someplace else with you guys in something that'll give you upside returns without the downside, right? Mitigate risk in the overall portfolio. Annual reset, baby. It's the best thing out there. That market's down, but you still earn. Where the people that were in the market, they're still below where they were. They got to make a bunch more money back just to get to even. So, folks, I did this very quick today because I know your days and your times are busy, and it's important that you're able to get out there and do what you do. But here's the thing, right? Do you really want to rely on the government to get us to and through retirement? Do your clients want that? Doubt it. Do you prefer to pay taxes on the seed or the harvest? If you haven't heard this concept, it is invaluable, easy way to explain taxes, right? Would you rather go out and buy a bag of seeds for, here, let's say this. Would you rather go out and buy a bag of seeds, a little pouch of seeds for carrots? Okay, assuming you have the time. Spend $1.50, $2 for that thing, plant those seeds in your garden and grow your carrots, right? Would you rather pay the tax on that, or would you rather just go buy carrots and pay the tax on all those carrots? I know it might not be the best example because I'm not talking in big dollars, but I think you get the point, okay? That's one that you can make to folks. You can't time the market, right? At least some of your clients' money, let's take it off the table. Let's take market risk out of it so that sequence of returns can be evened out a little bit. It's not going to be as drastic for your clients. All right? First step really is to set an appointment. So I'm going to ask each and every one of you that's on this call today, set an appointment with Bernard. Call him, ask him questions. Okay? Do that. If you're talking to your client, you tell him to set the appointment with you. But go ahead and call him. Please set that appointment so you can start planning your route. And one of the good things that you could do, and I say this to advisors all over the place, okay? Before the pandemic, I used to go around the country and do this presentation. Here's the deal. Look at yourself. Have you started thinking about yourself yet? Have you started your own plan? One of the best ways that you could get a strong understanding of this is call Bernard. Talk to Bernard about your top 3 or 4 clients that you have that would like something like this or that you would like to present this presentation to. Call him so he can help you get set up with that. But don't forget about yourself, okay? Doesn't matter if you're 20 years old or 60 years old. Don't forget about yourself. Start saving some money that way. So everybody, thanks for listening to me here. I know the presentation could have been a little bit confusing because I was trying to blend that as if you were a prospect versus the fact that you guys are advisors as well. So I want you to understand this presentation, Bernard and myself will gladly do it for anybody in a webinar format if you all can get 5 people to the presentation. Bernard will talk to you more about that, but we will gladly do that to help you out. I'm going to hand the reins over to Bernard, and thank you so much for listening to me today.
Chris, my friend, thank you, brother. It's always a pleasure. And folks, Chris is absolutely right. And you like this presentation, and we will be more than glad to host a virtual seminar for you using Insurance Advisors Direct's platform. I mean, we'll have an invitation made out, and all you have to do is just give it to your clients to come. And like I say, we do ask a minimum of 5 folks on the seminar. But we know how that goes though. But yeah, we'll be more than glad to do this presentation. Either Chris would do it or myself would do it. And then yeah, so let us know. And I'm going to get in touch with everybody that's on this call to see if you want to take us up on that offer. And in addition to that, with that, because we have, and I'm not the product pushing, and we're not pushing a product, but there's 2 products that will work great with Section 7702 plan or IULs, and that is Allianz and AIG. And what we'll do is get contracted with those 2 carriers, and as an incentive for each. And I'll say this from January 1st until March 31st, if you, per enrollment, per application, we'll give you $50 per application. Plus, if you get, let's say 120,000 in premium in a year's time, you'll qualify for a special trip. Don't know where that trip is yet, but you'll qualify for that special trip. So there's a lot of things in place that we'll do to give you a little incentive, a little boost for the production. And you see this little wheel right here that we have, and we're there behind you 100% from the carrier appointments. We'll run the case analysis. We have the sales tools and material that's needed. We'll application review. We'll go over the applications before we send it to the carrier to make sure everything is in order. We submit the applications for you. I mean, we're that whole back office support for you, as well as, so all you have to do is just go out there, get the clients, give me a call, Bernard, I have such and such person. They're looking to do this, and we'll create the case for you, and all you have to do is present it. But before you present it, we'll go over the case with you to make sure that you're able to present it. So yeah, we're behind you 100%. So what I'm going to do is, folks, if there's any questions for Chris or myself, here's the perfect time to ask those questions. All right, well, seeing none, like I said, I'm going to get in
Nobody
touch.
has, sorry, Bernard, I was just going to say, we sure nobody has a question. Feel free, I'm here to answer anything. Oh, somebody did type something in there.
Yep. So from Russell, how does the long-term yield compare to the market?
Compares favorably. This is something that we could talk about, of course, whenever you get any specific client or a case that you want to work on, right? Bernard will be able to show you through the illustrations what they are, but let's just talk Allianz, for example. Right now, a couple of indexes that they're running with over the last 10 and 15 years have actually averaged around 8 to 9%. I understand people will tell you this, that, and whatever about the market. But to have absolutely no risk whatsoever, 8 to 9% is great returns. Okay. Yeah, so I hope that answers your question. And of course, you want to go in further detail with how the index works with Allianz or whatever, Bernard can do that for you.
I think what we can do is, actually, there's two things we can do. One, we'll create a hypothetical illustration, and we'll get it out to everyone, as well as a case analysis, or one that shows your 401k or your IRA compared to Section 7702 plan. Here's another one. When an annuitant receives a guaranteed income distribution for a given year, does the exclusion ratio still apply?
Well, if it's an annuity, yes, exclusion ratios are always going to be part of, part of the annuity, right? Part of the payout. Of course, if it's qualified money, that doesn't apply, right? The exclusion ratio is just on non-qualified money in an annuity because it is tax-favored income. With 7702 plans, IULs, there's no exclusion ratio because they are 100% tax-free as long as the product stays in force, right? So what's going to happen is you're going to be able to generate proportionate to the money that somebody invests, puts in there throughout time and how it grows. You're going to be able to generate an income stream for life through the IUL that'll be 100% tax-free. I hope that answers the question. Of course, if any of you have more, or who asked that question, if they need it in more detail, just let me know and I could get more answer or more depth.
All right, thank you, Anthony. All right, folks, any other questions? I guess one question would be, well, Bernard, how do I get this started? So get this started, give me a call. And we'll definitely show you, get you appointed, and get you whatever materials that you need. And like I said, take us up on the seminar, the free virtual seminars for your clients.
Let me say one thing, Bernard, because I want to make this very clear to everybody. The virtual seminars, they're free, they're simple, they're easy. Bernard will get you invitations that you could email out to everybody. We have follow-up evaluation forms that you could use that help you with your follow-up with each person that's on there. But here's my experience doing these things throughout the pandemic. Every advisor that I've done these with that gets at least 5 people on, generally we get 2 solid opportunities out of that. And generally the comp on these things is in the range of average. Well, I'll just give you the average. Around $7,500 is the comp per case. All right. Now that's an average, right? There's people below that, people above that. But I am here to tell you that if you actively put into part of your prospecting the idea of, rather than calling somebody and saying, hey, I'd love to come over, sit down and talk to you about your retirement plan, which I'm not telling you to not do that, right? If you could get the face-to-face and don't need this, fine. But some people, if it's easier for you to call and say, hey, I'm going to be hosting a webinar with some great people that are going to be talking about obstacles in retirement on January 5th. I'd love to see if you could come listen in with me. It'd be great to have you there. You know, it's a lot easier way to have that phone call and to get closer to the appointment and to get closer to what you want to talk about. So please heed Bernard's advice and really, really do these seminars. Okay. It's a great thing for you.
Yeah. Anthony, to your question, yes, sir. Just give us a couple hours for it to actually download in Zoom, and then I'll send you the recording from Zoom, and then you'll be able to view the presentation again. Let's see, we have another one here. Okay, you're quite welcome, Anthony, my friend. All right, folks, if there's nothing else, I really do appreciate you joining our webinar. Chris, again, thank you. Oh, and just one note, you know, I did a presentation with my clients as well. And actually I have one person that is biting, that's interested, and we're going back and forth with him, but the presentation actually works. Folks will be very receptive to it. So I'll leave everybody with that. Again, folks, thank you. Chris, thank you. And I will be in touch with everyone so we can get this all set up for you. Folks, you have a good rest of your day, good rest of your week. Happy holidays to you. And we will be back actually the first of the year, unless you have some cases that you need, you have priority that you need us to take care of. Folks, here's my contact information. And hit me up anytime. My cell phone, call me actually my cell phone is the best number to get in touch with me on, and you can call me any day, any time of the day, morning or evening, if you need something. All right, folks, take care. Thank you.
Thank you.